Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know.
Well, hello, one and all, and welcome to the Companies and Markets podcast. I'm Mark Robinson. I'm sitting in for Dan Jones, who's off down the West Country this week, so we believe. I'm joined in the studio here with Michael Fahy, Valeria Martinez, and our old friend Alex Newman. And on the line from the West Country, again, we have Julian Hofmann. We're going to be talking about prospects for building suppliers and comments on Kia's recent sell-off. Michael Fahy will be taking us through that. We'll also be looking at the economic and investment implications of a potential German rearmament with Julian Hofmann. And Valeria will be talking about reach in particular, and specifically digital revenues in the publishing sphere in general. So it's been a week which again has been dominated by Donald Trump's trade policies, spooking the markets, obviously. We've seen major sell-offs across the Atlantic as investors faced intensified fears over the president's aggressive tactics there. There have been reciprocal tariffs imposed by Canada, the European Union, and China, but it may well be a case of who blinks first. I think the thing with tariffs anyway, it's a little like inflation. It doesn't really matter in the short term, but if it's a prolonged affair, then it creates major problems. We're actually about 3/4 of the way through the main reporting season of the year, and certainly the impression I've got so far is that it's been light and dark, really, because we've seen some major markups over the last week or so and some major markdowns as well, both here and across in the US as well. I think Melrose Industries might have been the largest faller in the UK over the last week, but there are also significant markdowns for shipping broker Clarkson and the construction builder Kia, and we'll be talking about those two companies a little later on. Over in the US, there was a predictable further markdown for Tesla, although I believe that that's come back a little now. And also the airlines took a major beating this week, and not just the airlines as well, but tourism in general, because along with Delta Airlines, both Expedia and Carnival were heading in the right or the wrong direction, rather. It may be the case that there'll be some opportunistic traders, investors out there looking for potential bargains after the brutal sell-off in the US. Valuations are still elevated, but they're moving to levels that are probably easier to stomach for the most part, whereas the FTSE may even be something of a safe haven. I read about this in Taking Stock this week as well, wondering if we might see a return to 2022 when it outpaced most of its main index rivals there, even though obviously it's chock-a-block full of mature industries and financials and energy stocks, those sort of things. That's one of the major criticisms. But it just shows that when you take on board its distribution characteristics, it should still have its attractions. There's been some speculation this week by Macquarie Group, who are usually pretty good on these sort of things, that gold could push $3,500 an ounce during the third quarter. I guess that would depend to a large degree how quickly the current trade impasse is resolved. As I say, it's the length of the tariffs really, rather than the severity of them, which is the main guider, I think. Also, we're at a period now that we're expected to beat our ploughshares into swords. So it was interesting that the chief executive of Legal and General came out this week to say that UK military companies should be considered ethical investments. And Julian and I will be speaking about the related situation over in Germany a little later too. We also hear that poor old Elon Musk is scrambling to secure a $56 billion payday from shareholders, but despite the sort of collapse in the company's share price. But without further ado, I think we'll move over to first topic. We're looking at building supplies. There's been a number of reports over the last couple of weeks. Forterra and Ibstock, both brick makers as well. But there's also been a few builders themselves. So, Michael, this is a sector that I know you're familiar with. So, could you give us an overview about what's happening at the moment on the sales front, and where both Forterra and Ibstock have been struggling?
Yeah, sure. I think if we take a bit of a step back, the building materials as a sector overall has been it's had a real rough couple of years from the sort of towards the middle of 2021 when inflation really started to pick up. Interest rates also started to move up. This sector has seen sales growth slowing and slowing, and then eventually they were in firmly negative territory. For the brick makers, particularly, it's been incredibly hard. I think in 2023 they were reporting brick dispatches, the amount of bricks shipped out was down about 30%. Last year, I think they were down about 10%. So there's been a real fall off in demand in that sector. And for both Ibstock and Forterra, it was unfortunately timed. Both had spent quite heavily on capacity increases. I think Ibstock had spent about 60 million on upgrades to its factory in Leicester. Forterra had spent even more. I think in total somewhere near 120 million on a new site in Leicestershire and an upgrade to one in Staffordshire. And the idea for both of them was that, or the pitch they were making to investors was that this was a market that had been chronically undersupplied pretty much since the financial crisis. A lot of capacity had come out of the market. As a country, the UK was importing something like 560 million bricks a year, which is about 20% of the total output. So their pitch was, we can secure more of this market if we make bricks here. It's much cheaper than importing. We can make better overheads, and we can take that share. And unfortunately, as I said, that took those factories started to come on stream at a time when demand was plummeting. Their profitability, in the same manner, started to go down quite a lot, and they ended up actually taking capacity out over the last couple of years, mothballing some of their older sites or closing them entirely. So yeah, when you look at this year's results, they are pretty bad. I think Forterra's revenues were flat, but profits were down about 30%. Ibstock revenue was down about 10%, but again, profits were down about 30%. So I think the question now really is where we're at in the cycle.
Yeah, I guess that depends to a certain degree on how quickly the MPC starts bringing down interest rates.
Yeah.
Because inflation's been a little bit sticky, really, that we only might end up with having a couple of rate cuts this year. But again, if our growth figures tend to bump along at the wrong end of the scale, then they may take a more accommodative angle on that as well. I guess affordability is a major problem, particularly with regards to new builds as well, because the ratios of median incomes to new build prices, that's still elevated compared to many other markets. I mean, Forterra, I covered them yesterday, it looks like they're operating at about 60% capacity, which in any industry would be problematic as well. And you would imagine that has a major impact on margins too. So it's not exactly an ideal position as well. But I guess, we could extend that also to the house builders. There are some signs that we're seeing renewed demand, but it's pretty early days at the moment.
Well, I think you covered Persimmon, and we've reported on quite a few of the others, Barrett Redrow, Taylor Wimpey, etc. And they're all talking about reservation rates edging up. Now there's no boom there just yet. And I was looking at the industry as a whole, the building materials industry, at the CPA's forecast, the Construction Products Association. And as I mentioned, sales growth went into negative territory. This year they are finally, it's been a moving feast because of interest rates, but this year they
Yeah.
are finally forecasting a recovery, particularly as this year progresses. And I think with an element of it, house building is the biggest part of this market. It's the thing that drives demand the most. And they were suggesting that even their forecast of growth is kind of couched in cautionary language, because I think it has to be, given the current state of the market and the fact that mortgage rates started to pick up again at the end of last year on interest rate expectations. As you said, those cuts should feed through at some stage this year. The market for house building, there should be some pickup there, especially with government initiatives. We had the planning and infrastructure bill out this week, trying to remove some of the blocks that they see for both significantly important infrastructure projects, but in general in planning committees, they're talking about streamlining planning committees or bypassing them if they stand in the way. So there are definite tailwinds that should, as this year progresses, support that market. And as you said, with Forterra operating at 60% capacity, both brick companies have huge fixed costs in running the factories, in the heat needed, the energy needed to produce the bricks. So if there's a pickup in revenue, because of the high level of those fixed costs, there should be the operation leverage benefits feeding through into profitability.
I mean, there's even been some talk of resurrecting Help to Buy schemes as well.
Yeah.
I think the jury's still out on the impact that had on the housing market, been a potential inflationary effect, certainly over the short to medium term. But we'll leave that one to Rachel Reeves. I guess when you're looking at the brick makers as well, there's a very strong sort of net zero argument to reshore a lot of that production.
There is, and also the both companies have talked about the fact that the new plants that they are bringing on stream are much more are much less energy intensive than the ones that they're mothballing.
Yeah.
So it's and also highly automated as well. So in terms of shareholder return, should be more efficient.
So there's a lot of jobs going there. Well, there normally was a lot of jobs going for sort of 8-year-olds and 9-year-olds in the past in the brick making industry.
Thankfully, less so these days.
It's my Luddite tendencies. Sorry to say, you were looking at Kier and a construction giant as well, and their shares were pretty heavily marked down this week. And you thought that was a little bit anomalous?
Yeah, I mean, I think I titled the piece that the share price fall was hard to fathom. I really did struggle to try to work out why. You look at guidance is for the full year. These were half-year results, is pretty much in line with the company said where it was going to be. You look at the balance sheet, and again, Kier over the long run has not been a great investment. At the time of the Carillion crash, it lost most of its value. It had to do a couple of emergency raises in the past. It's had to sell off its property arm, and there's a chart in its annual report which makes for pretty depressing reading. You look over 15 years, its total shareholder return is like a negative 73%. But since 2021, there's been a real pickup. It changed its business model in the wake of that Carillion debacle. It's doing much more of its work is government linked, and much or public sector or utilities. So there's a greater security around the size around the order book. There's also, I think, 3/4 of the order book is based on infrastructure projects, and pretty much all of that is done on cost plus contracts. So in the past, where contractors have tripped up because they've priced things and prices have moved against them, here you should be protected against steel prices and other inflation going wild.
Yeah, I think a lot of the companies linked with infrastructure as well struggled after Carillion because of the the legacy contract issue as well. But it's worth remembering that support services went through the same thing
Yeah.
a good 20 years ago, and it took a while for them to bounce back, but they've done pretty well, or fairly well in recent times as well. So that was a significant markdown this week. There was another one actually for shipping broker Clarkson. Now, whether this is a reflection of wider economic malaise is difficult to know. But Alex, you've been taking a look at them, haven't you?
Again, in a similar category of slightly hard to explain sell-offs, they fell a fifth on Monday, which I mean we should say was obviously a brutal day for markets generally, and plenty of uncertainty and confusion for trade and geopolitics. So the timing wasn't fantastic in terms of releasing their results. The shares were, I suppose, also near their all-time high. I mean, like in the case of Kier, I think I totally agree with Mike. Just looking at the results, they it's really hard to understand the catalyst for such a big fall, other than I suppose they are up something like they were up 150% since the beginning of 2023. So, we can't rule out some profit taking, just on results that investors may have been waiting for, some major upside. So in the case of Clarkson's, there was also a bit of an analyst downgrade on the outlook. I think about 5% of future earnings per share forecast for the next 3 years. The drop in the share price meant that it has derated from something like 16 or 15.5 times to 13 times forward earnings. So that's a lot more to do with sentiment than some abrupt negative factor that the analysts are forecasting. And just to maybe try and sketch out a reason, it's a little hard to completely explain, but the comments from the chief executive of Clarkson's, Andy Case, were that included some slightly vague statements. Markets have softened as economies grapple with the immediate impacts of this phase of change. For some years, we have now started each new financial period with an uncertain geopolitical outlook, but this year has started with more uncertainty than most due to political change. I think everyone grasps the fact that shipbroking deals with lots of geopolitical and market uncertainties. This tone may have just struck investors as, maybe sort of hedging bets on what they can realistically expect this year. They've said that freight rates are down already. It's going to be second half weighted in terms of profits. So yeah, I mean, we've got this. We essentially have had a bit of a rug pull in terms of sentiment, and that probably reflects the big drop in the share price this week as well.
Yeah, that was down by about a fifth, though, wasn't it? So I mean, there must be an element of profit taking in there as well. I imagine, as you say, they're trading close to their 12-month peak.
Yeah.
So
there's also this thing though with broking or shipbroking, or any kind of broking really, like with banking, you've seen more generally. I mean, there's a number of Wall Street executives out this week, kind of welcoming Trump's policies. It might be what they feel they have to say, or maybe even, or equally cynically, it's an honest reflection that volatility and turmoil is good for investment banking, trading desks.
Yeah.
And the fact that it doesn't appear to be the case that turmoil or volatility isn't working in Clarkson's favour may have struck some investors by surprise. That actually the idea that this is just a weaker economic signal or weaker kind of operational expectations from management might have just unsettled things a little.
Yeah, it seems that way, doesn't it? So I think we'll just move away from the building stroke construction sphere at the moment.
Just before we do, I was going to mention valuations because these were both Forterra and Ibstock, I think, were broker tips last year. That didn't really, it worked out brilliantly for when Labour first swept to power, and there was an expectation that that house builders and the building material sector would all see an instant benefit, but then that fell away. Again, a few of them were tipped this year, although the results were bad and share prices sold off a little bit. There were comments from both companies about a potential recovery, and I was looking, although the valuations, because they're on trough earnings, if you're looking at a PE ratio, don't look too great. They look cheap if you value them on an enterprise value to cash profits multiple, and there is potential that you think that they could attract a bid. And then if you look at like the peg ratio, which we refer to in the magazine quite a lot, I crudely always say it's pretty much the price that you are paying for the implied growth. In both cases, the peg ratios are really low.
Yeah,
which indicates that they are cheap.
well, exactly. Well, yeah. I mean, there's a bit of a debate there, isn't there, with that, if the peg is quite as meaningful in terms of mature industries. But I'll take your word for above mine anyway, Mike. So I guess another feature of a second Trump term is that he's reiterated his demands that European countries need to step up their defence spending, and this time around, I think it's been more warmly received than during his first term. So Germany was chief among them, obviously Europe's greatest economy, and Julian, if we could just bring you in here as well. They've made the incoming Conservative Chancellor has been tasked with building up the country's armed forces. What are some of the issues here then in the piece that you put in the magazine this week?
Yeah, thanks, Mark. Yes, I was just checking whether I was still eligible for conscription, but luckily this summer I'm too old, luckily. There are some real issues. So last week we talked about the lifting of the debt brake potentially, which is actually still in negotiation with the SPD, the CDU, and the Greens in Germany. So it's not exactly a done deal, but I think the general feeling is that they've got to do something by the 25th of March when Parliament dissolves. My interest was in the article was to see how possible it is for Germany to fund its rearmament on the one hand, and secondly, what are the challenges and problems that it faces doing so? And does this support the incredible valuation of Rheinmetall, which is companies like Rheinmetall, Hensoldt, who have exploded in value over the last couple of years? You could buy Rheinmetall shares in early 2022 for about €100 each, and they're now trading at over 1,200 a piece. So that's definitely a 10-bagger worth keeping.
Is it justified, do you think, that rise?
Well, if you look at the numbers, I mean, already Rheinmetall's, before the debt brake debate, Rheinmetall's order book was already €50 billion and counting, which at its current rate of production is about 8 years of orders. It's frantically adding capacity in various ways, one of which actually is to take abandoned VW car factories and turn them into manufacturing facilities for armored vehicles. Yeah, I mean, it's going to take a lot of money. When I looked at the parliamentary report into the readiness of the German army, it was that kind of thing used to be a sort of a running joke in in publications like the Daily Telegraph about how useless the Bundeswehr was. But when you read it in the current context, it's actually quite alarming that a third of the posts in the German army are not filled. The average age of soldiers is 34. They've spent about 80 billion of the previously announced 100 billion fund on equipment, and it has hardly scratched the surface. They still have lots of tanks and things that aren't working. So getting that right, essentially reversing what was 30 years of neglect, is going to cost hundreds of billions, if not trillions. And even getting it to a state of acceptable readiness is going to be a vast and very difficult task. So you can argue that this is one of the few occasions where such a run up in the valuation of a company is probably more than justified by the situation that its customer finds itself in, which is it's highly unusual, but it is inevitable given the state of Germany's armed forces. It has effectively no defense against Russia. And if the Americans decide to pull out tomorrow, then that would be very serious.
Just to remind me again, Was West Germany sort of adequately armed during the days of the Warsaw Pact?
The West Germans spent, up to 8% of their GDP on defense, whereas the modern post reunification Germany barely managed 1 to 1.5 at various points, at the lowest point.
Yeah,
So
I think we were even spending about 6.5% in 1989.
at the height of the Cold War, I mean, that's definitely. I mean, there's always this thing like if you want readiness, you have to maintain at 2%. If you want it expanding, it has to be 4%. If you want to deter anyone, it has to be more than 5%. So it's got to head towards that direction. And if you value defense spending by say 5% of the German economy, then it's got to rise from something like 60 to 300 billion a year just to maintain itself at that level.
Well, naturally, the European defence contractors have been some of the best performers over the last year or so, and I guess that's set to continue if European politicians do follow through with these increases.
Yeah, you're not going to lose money on defence, yes. There's no way.
Yeah. Okay. On a slightly different note, Valeria Martinez has been looking at reach specifically this week and digital publishing as a whole. So, Valeria, if I just bring you in now, how big do you think e-commerce can really get for publishers, and could it ever overtake advertising as their main money generator?
The simple answer is we still don't know, but publishers do need to do something because the advertising space is just getting tougher and tougher for them. The big tech companies are grabbing an increasingly larger share of advertising spending. Obviously, print revenues are declining. The advertising that comes with that is declining as well. And digital advertising, which has been sort of growing steadily in the last few years, is also sort of shrinking in a sense. Again, the big brands are sort of prioritizing social media platforms and that sort of thing instead of publishing. So whether it can grow into a significant business, there are some examples, but it's sort of part of a big push from the publishers to look into sort of non-advertising revenues. And e-commerce, it has worked really well for publishers like Future, which it started its life as a magazine publisher, and now it has a lot of digital titles that have quite a big sort of digital readership. For Reach, it's a bit of a different story. It has only just started sort of looking at e-commerce as a way to offset declining print revenues and print advertising sales. But its main challenge is that it's a little bit more difficult to get your readers to spend money, just given that it's quite a general audience. For Future, it has titles such as Tech Radar and Who What Wear, which is a fashion sort of digital title. They publish a lot of buying guides and product reviews. Their audience is much more inclined to make a purchase because if they're in the site, it's because they're doing some sort of research for a product. So yeah, it's probably unlikely to fully replace advertising anytime soon, but it's certainly something that's growing for many of these publishers. Pretty much every news publisher out there has sort of dipped their toes into e-commerce, but it's still very early days, and it's still quite a small part of total revenues for these companies.
I guess the nature of the industry here as well is likely to be evolve in line with the development of AI channels as well, because that affects both ends of the scale there, conventional advertising, e-commerce, but also the highly targeted end too. So do you think it's realistic for Reach to build and scale its own marketplace?
I think it can. The main problem with Reach is that management has sort of stuck to this free news kind of business model, so they don't really have any sort of revenue coming from subscriptions across its titles. So if digital advertising keeps slowing down and obviously print revenues are they keep dwindling every year. They do need to look into this area. The key advantage for Reach is that it has a huge audience. I think it's about 32 million people across its brands. But obviously the main challenge is whether, they can convert them into shoppers. Last year they launched this thing called Wimbly, which is an online marketplace. They sort of describe it as a curated marketplace, so it's products that they recommend. Again, it's very small. They only started last year, but the question is, do we really need another marketplace? Do we not have enough with Amazon? It will require quite a bit of investment from Reach to be able to scale it. It's quite difficult for publishers to rank really highly on Google these days, so they'll have to invest in an SEO team. So yeah, the thing with Reach though is that with the declining print revenues, it has quite a big chunk of pension commitments every year, as well as dividends. It doesn't have as much wiggle room to invest in e-commerce, but it could potentially buy niche brands just like Future did. But yeah, it's definitely going to be a bit more of an uphill battle for Reach than it has been Future. It's definitely not an easy model to replicate.
Well, it wouldn't be the first time that the owner of the Daily Mirror has had some troubles with the pension obligations. But it's difficult to imagine what old Bob Maxwell would think of the changes to the industry, but it's an evolutionary front without a doubt. Okay, well, I think that just about does it for this week as well. So I'd just like to thank Valeria and Mike, Julian and Alex for their contributions. And Dan, with any luck, will be back next week, and I have no doubt by then that the markets the turmoil may continue, or there may be a spot of profit taking. But until then, goodbye.